Ladies and gentlemen, thank you for standing by and welcome to the conference call with HDFC Bank Limited. At this time, all participants are in a listen-only mode. After the speaker's presentation, there will be a question and answer session. To ask a question during the session, you will need to press star 1 on your telephone. Please be advised that today's conference is being recorded. I would now like to hand the conference over to your host today, Mr. Rahul Jain. Thank you. Please go ahead, sir.
Thanks, Jason. Hello, everyone. Welcome you all on the call with the senior management of HDFC Bank, hosted by Goldman Sachs. We have the pleasure to host Srini, who is the Chief Financial Officer, and Rahul Shukla, who heads the corporate banking at HDFC Bank. I'm Rahul Jain. I head the financial sector for GS India, and I'll be the moderator for the call today. In terms of brief profile of our speakers today, I'll quickly introduce Srini and Rahul, who I believe as such doesn't need any introduction, as many of you are already well acquainted with them. But for the starters, I'll quickly introduce. Srini is the Chief Financial Officer at HDFC Bank. He joined the bank from Citigroup, where he was present since 1991 and held several leadership positions in diverse geographies such as Singapore, Hong Kong, and New York. During his 27 years, he successfully led financial controls and processes, financial planning, treasury, and expense control management. Srini, thank you so much for joining us for the call today. Our next speaker is Rahul Shukla, who is the Group Head of Corporate Banking and Business Banking at the bank. In his current role, Rahul is responsible for managing the entire corporate banking group, which deals with large corporate and business banking, which covers the SME segment. Prior to joining the bank in March 2018, Rahul was Head of Corporate Bank South Asia at Citibank, where he was responsible for coverage of large corporates and the MNCs operating in India. He began his career with Citi at 1991 and served in various senior leadership roles across investment banking and corporate finance. Rahul, thank you to you as well for joining the call today. Before we get started, I'll read out a customary disclaimer. This call is strictly for the clients of Goldman Sachs only. It is not intended for media and is off the record. If you're not a client of Goldman Sachs or you have not received an invitation to join this call directly from Goldman Sachs, you should hang up now. The format of this call is purely interaction-based. In case you have any question, please enter in a touch tone, star and 1, or else email me on rahul.m.jain@gs.com. With that, I'll start the discussion for today. Let me first go to Srini for his quick thoughts on the business front for the bank, particularly post the budget and the recent Rbi Monetary Policy, which seems to suggest that the momentum is gathering pace. So Srini, if you can shed some light on how do you see qualitatively, of course, the business momentum at the bank, and plus your thoughts on the interest rates. With that, let me hand over the floor to Srini.
Okay. So first, maybe we'll take thanks, Rahul, for this opportunity to speak to you and to the team here on the call. First, we probably start with the RBI monetary policy or the situation, and then from there we get into the kind of that, because that serves as the backdrop or the bedrock on which the activity happens, right, from that sense. If you look at the RBI policy right from the pandemic beginning time, it's been a very loose monetary or liquidity policy, right, by RBI. And rightly so, to put a lot of liquidity in the system, and it was pretty useful all along through this. Now the RBI seems very keen on normalizing this liquidity. But at the same time, normalizing means will still make adequate liquidity available in the system. Right? The surplus liquidity, while it will be lower than in the past, but still will be tremendous amount of surplus. We think that's maybe 4 to 5 trillion Indian rupees instead of maybe 6 trillion plus, right, seen earlier. So significantly higher levels of liquidity even after normalizing and so on. And then if you think about then what is that normalization to some extent that is required, you'll see that there are a few things that are going on. One is the inflation risk, of course, right, especially the core inflation. So that is calling for reining in some of the liquidity to keep it under control, keep it under kind of a management that they could comfortably handle with, right? Then At the short end, there is an acute distortion that you see in the rates, where the overnight rates like the TREPs are trading well below the reverse repo rate, right? That's one other reason for concern and one other need for that is driving the bid to normalize by the Reserve Bank on that side, right? So that's the kind of a context that you're seeing. And controlling the yields is also one of an important focus, right? Particularly the benchmark yield, call it the 10-year benchmark yield, right? So that is a good type of focus that is there. The other tenors will, whether it will respond as much, but it will respond much less to the yield curve management, which is the open market operation or the operation twist type of management. The other tenors may respond less, but the benchmark yield will respond, we believe, quite well to that kind of thing, right? So we see the demand for bank credit returning to some extent, because whatever the disintermediation that happens with the high levels of liquidity and certain sectors or certain kind of institutions directly accessing capital market may be reduced, and so thereby the bank credit, apart from pandemic depressing to some extent the bank credit, it is also the disintermediation that also caused some of the bank credit to be slightly lower, right, than what you would have imagined during that period. But right now, we do see that the bank credit returning to some extent, right? Our forecast, our house forecast, our economist house forecast is that FY22 could see 15-16% credit growth, right? But that is also it is amplified to some extent due to the lower base, and that is the kind of a context you need to have that, right? The base is lower, and so 15-16% by itself may look pretty big, but it's also some kind of a rebound also coming, credit demand coming, right? Previously, what it was being disintermediated is coming back to some extent. That's something. Like, even when these things are happening and the credit demand and the growth is seen to some extent picking up, while you withdraw some liquidity, but still enough liquidity, as I told you, in the system surplus that will clear out. Then in terms of where are we seeing now, right, in terms of how things are. After the busy period of October, November, December, which had the dominance of some festive activities and so on, we do see good continuance of that kind of an activity as we get into January and so on. So we do see those things quite closely sustaining, which you see even when you look at the GST collections also, the January GST collections at 1.2 something is higher, trillion is higher than 1.15 trillion in December. So everything is on the upswing, right? It is incrementally month to month to month to month. When you look at it, it is at a trajectory which is on the upward sloping arrow. So from that sense, it all works well. And the spends are doing good. But air travel or the hotels and those kind of segments, when you look at it, they are still muted to some extent, right? You imagine, because while we can say that the pandemic is more than off behind, mostly behind, and we are at a different stage of the pandemic, but still the hangovers of those things are all there, and you don't see much travel and hotel spending remains to be muted. However, as a business, us as well as the rest, there are several programs with the consumers' engagement, like the several EMI programs are running, which are attracting good customers, good business around the EMI programs, let it be the mobile phone, the furniture, the electronics type of EMI programs. There are offers, merchants offering a lot of offers to customers, and so people are drawn in into those kind of offers. And we have responded well in terms of keeping the customers engaged with a higher credit line increase, or giving them some smart way, running some programs to keep them engaged with us and so on. So we have been quite active in keeping them with us and keeping the credit flowing from this sense. That's how I would describe in a few minutes if you ask me how things are shaping up as we speak now.
Thanks, Srini. So basically, you think while RBI is pulling back some liquidity, it still remains fairly comfortable. Your quick remarks or thoughts on interest rate behavior. Of course, short end has gone up. Would it mean that the deposit rates would also start to harden now? The easy money which was available to, let's say, the non-bank finance company, etc., would that start to kind of be pulled down, and therefore the ball would start swinging in the favor of banking sector? And any quick thoughts on the interest rate side before I move on to Rahul?
The interest rate, which is the bank deposit interest rate side, in the near term, nothing should happen. I'll give you a couple of things. One is, if you look at the credit deposit ratio, the credit deposit ratio is pretty low. Am I on the line? Hello?
Yes, we can hear you.
There was some other beep, that's why I thought maybe the line went off here. Okay. So the credit deposit ratio is remaining low at 72 and change, right? 72.8 or something credit deposit ratio. So we don't see in the short term any hardening of the rates. It cannot happen. But sequential credit expansion as it picks up, the pressure on deposits will pick up for sure. But that is not likely, that means the pressure is not likely to surface at least until the end of the first half, which is August, September or thereabouts, or in the second half. That's where perhaps things will start. And maybe that is also the time when RBI may look at the interest rate itself, right, whether the rates where they are, whether the reverse repo at 3.35 or the 4% repo rate, but then that's still valid. Maybe at some point in time, that's when perhaps in our view or house view that there may be a review. But we don't see this given the low credit deposit ratio, and we have another more than 6 months, 8 months to run before there can be anything that will come as a pressure on that side.
That's very, very helpful, Srini. With that, let me move to Rahul. Rahul, to start with, your quick remarks on your conversations with the large corporate, the medium-sized corporate in India. There has been a lot of euphoria, particularly after the budget, that India perhaps could be starting a new capex cycle. So can you share some thoughts, some on the ground feedback to set the context?
Sure. Thank you, Rahul. I must tell you that I live in an apartment where when I look at the seafront, there is non-stop coastal road project work going on. And at the entrance, it is all dug up for laying the cooking gas pipeline. So I see capex every single day. Having said that, you can see the government spend on infra everywhere. And I believe that Ministry of Finance has a dashboard which tracks daily public sector capex that has happened and release of supplier payments. You would also have noticed that today, for example, most of the public sector, other than the government, spend on infra. You look at Coal India, there was a news item that said that they had a budget of capex in this year of 10,000 crore that is being increased to 13,000 crore. You have capex from NTPC, Nuclear Power Corporation, Power Grid Corporation. You have a lot of capex, going on funded by IRFC, for railways, gas authority, steel authority, ONGC, and so on and so forth. They're all incurring capex. So my thought process, as I was thinking about, the budgeting process that we go in internally for next year, was that the first half is going to be supported by government capex. And then the private sector capex will get dragged in towards the second half. But having said that, we are currently seeing, because I have this benefit of seeing, basically the full gamut from large corporates to mid corporates to the wholesale SME. And I must tell you that in wholesale SME as well as, mid corporates, we are actually seeing, capex requirements today. And it is in sectors such as, textile and packaging and food processing, pharma, auto, papers, some in chemicals and so on. And Rahul, you would agree that that is a very, very good sign for the economy in terms of just the capex revival. Thank you.
Interesting data points, Rahul, straight from the grounds up. I think two questions I keep getting from the investors, and of course we'll open up the floor as well to them, is, India, if you look at the PFCF to GDP, the private fixed capital formation, has been coming off for the last 10 years. Do you think we've kind of reached a stage where the corporate balance sheets have been largely deleveraged? Commodity prices are going up, so this is a good setup, for it to revive. And within that, of course, execution is always a bit of a not so exciting story in certain sectors because of policy, lack of policy certainty, etc. So when you look at, let's say, going beyond the next half or the half after, let's say next 3 years or so, how do you as head of corporate banking think about the new capex cycle in India? Do you think the setup is ready, or we're kind of still getting there?
So let me, begin with basically government, talk about, corporates, and then talk about, the banking segment, because all of these, stem into the corporate capex cycle. So when you look at the major event that has happened is basically the budget announcement, and I think what is most helpful is the gradual fiscal consolidation glide path, which improves the government's ability to spend to support growth. But it is notable that the quality of spending that helps with jobs as well as inflation management, that is being kept firmly in mind. If you look at it in the budget, the capex is expected to grow 26.2%, while the revenue expenditure is expected to contract by 2.7%. And if you look at capex, that is expected to increase to 2.5% of GDP. And if I take anyone back, the last time we saw 2.5% of GDP in capex, that was in fiscal 2006. So after 15 years, we are basically attempting this. Obviously, a lot of it depends on execution, but the way the government is going about it, I feel a bit more comfortable. The spending is also coming at a time when demand has picked up and remains very, very strong. Now, we hear about all these demands, but I was discussing with friends of mine, and, basically the discussion was that in India, there are about 1 million marriages that happen every year. And each one of that requires a spend on an average of at least 1 million rupees. And that's about, 1 trillion rupees in spending. Since that did happen, last year, and that gets caught up, in this year. So a lot of, such postponed expenses are going to, come in this year, which is going to, again, be pretty helpful. This growth is also supported by healthy corporate balance sheets at this point of time. If you see, corporates have repaired. There's been a series of deleveraging. A lot of corporates, who were, if you thought a year and a half or 2 years ago, were just on the brink, have delevered, quite significantly. The lower tax rates also are now, basically helpful. And if you see from the largest, groups per se, everybody talks about only deleveraging. You saw Tata Steel's results and you saw the impact of, deleveraging. You coming back to your capex, question, you heard them yesterday, speeding up the Kalinganagar expansion. And so that basically gives you a certain, sense. The deleveraging continues. The corporate balance sheets are in very good shape. And at some point of time, it is going to re-lever to go out and, start expanding, because that is ROE accretive, and that is, what they're going to look at. And the last factor is basically the banking sector. Now, if you look at, the largest banks, a lot of, debt cleanup during pandemic, before pandemic has happened. Every quarter you go out and see provisions. And so, and then here I'm not talking about HDFC Bank, but the system in general is quite ready to go out and support lending. And when the banks are ready, at the end of the day, that, goes out and gives a massive, boost to the economy. So when Srini mentioned about the growth rate forecast for next year, whether IMF or budget or any other, agency, you're talking about 10%, at least of real growth rate plus 5% inflation. That's about 15%. You're looking at, even without a multiplier, a 15% credit growth rate. And that's, quite significant. The question you have to ask is, given, the way this 15% gets divvied up today compared to 10 years ago between certain private sector banks and, State Bank of India and a few other banks, that are the banks in a position that they have the capital as well as the liquidity to go out and lend? And I think, basically all of these banks are ready. So we, at least, when I look at it, we are basically getting into a massive upgrade cycle. And the fiscal consolidation roadmap is not just, 1 year, it is basically a 5-year, roadmap. And it's a gradual easing up, to 4.5%. So the government continues to remain, basically supportive in terms of, helping the corporate sector capex get pulled into the benefit of the economy, and that's pretty positive. So I am, very positive around, the medium term capex outlook by the private sector in the country, Rahul.
That's really encouraging, and I'm sure Shashi will keep increasing your budget targets. But nonetheless, we'll keep discussing about that. Operator, can we open up the floor for questions?
Certainly. Ladies and gentlemen, we'll now begin the question and answer session. If you wish to ask a question, please press *1 on your telephone and wait for your name to be announced. If you wish to cancel your request, please press the # or # key.
Sure. While the question queue gets formed, I'll just go back to Srini and ask a very topical, top of mind question about any update on the technology front. Your engagement with the RBI, anything that you want to update the investors, Srini, on that front?
Okay. Nothing new on that front, but then just to recap so that it is fresh again, is that we have given certain things that we are working on, right? Some time ago, December, I think, we had said certain things that we are doing. We are making progress against that. We can go into one level more of detail into it, but that is the kind of progress we are making, right? And all of the actions we take as positively that will raise the standards of the bank to set us apart for a greater kind of a delivery. That is another kind of inherent, we are developing inherent strength through that process to get on and do this, right? The regulator will institute a process which I think is going to commence any time. We put it out on February 2nd, I think, in terms of doing an audit, and then the Rbi will do a detailed review of that. We'll take it from there, from that side. But then in terms of the actions, we said we'll do a few things, which is how do we strengthen the DR, disaster recovery, and look at it application by application. That involves several things in terms of how we data center, process and drills, mostly process oriented, right? The process and drills are reviewed well. We are able to go through that. And again, on-site presence of staff 24/7, and we do have, but we do across the board, across various kind of activities, how we could have that in place. The last time, the November 21, the Saturday evening, 5:30, when the power went down, some people had to come, right, from somewhere to get that done. So now we're trying to see how do we augment, including having discussions with our key facilities unit, right, whoever is managing our facilities, having conversations with them to ensure that the technicians are quite trained and available. And then advanced level of daily drill, right, in terms of simulating each of the scenarios and conducting those things, so that it is becoming a day-to-day kind of an activity rather than you do once in a while and figure this out, right, for disaster recovery. How do you get that into a daily drill simulation? And that also in every shift, how do you get that daily drill simulation in every shift? Like, let it be the generator set manual operations to start, or any other process, as an example.
Joining the meeting.
So that there is no such gaps that we see, right? And then multiple failover tests for the automatic DG to switch over, and those kind of, right, testing all the utilities like the UPS or the electrical circuits, the cooling systems, and so on and so forth. So that this becomes a kind of an hygiene matter day to day rather than kind of a disaster recovery one time kind of a network, right? That's something. Then in terms of the recovery time rationalization, right? That was part of it. Was down last time from around, call it about 6:30 to about 8:30. A couple of hours it was down, and UPI I think was down for a little longer time. The one other thing conundrum that always happens is that, hey, if this is going to come back in 30 minutes, 45 minutes, 1 hour, do we need to switch over to the disaster side? The switchover time, that is what we saw the call about as the recovery management time or the recovery point, right? So at which point it recovers. And we're trying to crunch that also, and we tested a few and we key applications tested to crunch that recovery time so that if any eventuality were to come, we don't worry. We just the recovery time is shortened, so we just simply switch to the disaster recovery kind of side, right? So that's something we are trying to work. There are some things that are short term. I described a few examples of certain process related, how on a short term basis we are addressing, and there are certain things which are medium term or long term. Example, how do you even look at the entire architectural efficiency so that some of this could be automated, orchestrated, and moved over, so there need not be any manual kind of a process to switch it over and so on. And much more longer term strategies, of course, how do you even go to a cloud? And so those things, the medium and the long term are all more work in progress, and we continue to move along. But the short term ones, we are addressed, and we are addressing some of them and progressing well according to the timeline that we have laid out. And of course, all of this is in consultation, in discussion, and direction of the board, and which we have also communicated with our regulator in terms of what we keep them updated about what we are trying to do and how we are achieving it.
Makes sense. Thank you so much, Srini. Operator Jason, can we start the Q&A, please?
Certainly. Your next question comes from Kunal Mehra from MLP. Please go ahead. To the investor, Kunal Mehra, your line is now open.
We are not able to hear him. Maybe we can move to the next participant, please.
Sure, no problem. I'll now pick the next online. Your next question comes from Sanjay Paket from Nippon Life India. Please go ahead.
Yeah, thank you very much. Congratulations to Rahul and team. Such a tough year, commendable performance, particularly risk adjusted. So that's really congratulations to the team. Rahul, what you did mention initially about the cycle coming back. I had a related question. One is this low interest rate. How big is the trigger for capacity creation? And do you think that with capacity utilization in certain cases being at a reasonable level is leading to preponement of capex that corporates are looking? That's the first question. And the second question is in SME or micro, where again, our credit selection has been commendable. Which are the areas where actually you see no stress and you not want to lend? So these are two questions I have.
Sure. And the first bit was, driver of growth. What was that? Interest, is it?
Yeah, the order is, I think it's a lower interest rate with some pricing power and utilization level at reasonable level. Particularly lower interest rates, which we've never seen, a very well-rated corporate like Ultratech borrowing 3-year paper at 2.7. So such instances, do you think is going to trigger the capex formation?
So, let me say this. The last time, we had a massive capex, cycle that was 2006 or 2007, and the interest rates, if I recollect, were, in mid-teens, right? And oftentimes I say that, look, if 1 or 2 percentage points, change in interest rate is going to move your IRR and say that, whether you do a project or don't do a project, then, that project itself is wrong, right? Having said that, we are today, in an environment where the real interest rate is effectively zero. If you take out, the inflation, or maybe even slightly below zero. And when you have that basically, by economic theory, gives a massive push to, one is, consumption, and also, helps build up basically that focus around capex. But what is different, this time, right? If you go out and step back, what exactly are we doing as a country, right? So I talked about, budget. I talked about corporate balance sheets. I talked about, basically a banking sector, which I think, is in reasonably good shape. Even if you look at, the GNPAs of the sector, if you take out the provisions that have already been created, I think the part of the problem is, basically very, very small. Go back and look at, how we did in the last 1 year. And it was, basically the government came out with several packages around Atmanirbhar Bharat. It was 20 trillion and all that, and there were many other schemes. But there were 2 or 3 schemes which created a massive, basically flow-through effect in the economy, which will continue to support, in the next few years. The first was that 20% MSME scheme that they came out and they saved, basically a segment which was requiring a certain amount of help, right? The second was, if you look at it, there were the liquidity measures by RBI, and if you go back in March 31st and June 30th, and if you recall, there were a lot of, basically smaller banks or NBFCs that people weren't sure about, and today all of that, has been stabilized. And the third was just the food grain delivery from the godowns of the government to the poor, that again led to a massive procurement of food grain for purposes. And thankfully, we're having good monsoon, and so that provided a strong support to the agri segment. So there is a pretty coherent policy that goes out and supports. Now, once the government starts kicking in and does daily monitoring of the capex, obviously capex will happen, and obviously then the private sector gets dragged in. If you think about the next one, the PLI scheme that the government has come about, right? Now, you go back and look, people who achieved excellence over the years, and in the 80s it was Taiwan, and they came and brought, their engineers back from the US, and they had this good scheme of the employee stock bonus method, where just a nominal value flowed through the P&L. And while you may think that the expense on the P&L was, let's just say, 10,000 Taiwan dollars, the actual value of those stock was, basically about $1 million that didn't flow through. And that caused a lot of engineers to come back and led this entire IT and semiconductor in that country. Look at China, where there was a lot of investment credit and state support, that was given. And we now have this scheme, the PLI scheme, which supports, a large swath of sectors. And it basically is something that, where the government pays as you go. So as more and more, basically production, comes up and, sales happen through. So there is a very coherent policy that is, supporting. And so I think, beyond interest rates, we have to look at, the government policy, which is quite important. We also have to look at, the health of the banking sector, which is, there is no rival to reviving growth than, basically the health of the large banks who are going to go out and do this lending. And the third is just the corporate balance sheet itself. Your next question is on SME and micro. Let me tell you this, our belief is that, SME and micro will even be bigger than corporate banking for us in time. And if I look at it, I think our MSME segment is, as of the last, balance sheet reporting date, is roughly about, 2 trillion rupees, which makes us second largest and in the country after the largest bank in the country. Now, our belief is not that, we choose, sectors, this and that. Number one, it has to be granular. Number two, all of these, names are names where we have been banking them on the liability side for years, so we know the guys. We, take basically customers who come on board, through referral. And my belief is that I have to penetrate deeper and deeper into every single district in the country. So if I have, basically today, ballpark about 550, give or take, districts in which I'm operating my SME business, and, obviously where, I've gone and put a flag post, I'm going to, go deeper. My goal is that, I should be somewhere around, 625 districts. And so you count and you keep increasing. When you do that, you can't go wrong. You don't need to go out and, choose sectors, because as the second largest bank, if I have to continue to grow, it would be foolhardy if I look at it, in that fashion. I have to look, that I am giving money to a guy in any segment where he has or she has the cash flows to return, basically that money. And that is the core principle. Look at the large corporates, we stay away from power sector. But if you went out and, gave basically lending to say, for example, NTPC or Nuclear Power Corporation, then you are all right. And that is the philosophy that we take. We like, the agri sector. We like textiles, packaging, food processing, pharma. I can just keep reeling off. But our push is, more granular and going deeper. Unfortunately, banks who basically go out and do this business, if you restrict yourself in just the big cities, then you become a prisoner of low yields and low returns. And you have to get deeper where the customer values your digital, offering, and you keep expanding. It is just a much better business proposition for me. It's a much better proposition, for the customer who I onboard. And that's how we are progressing, step by step here.
Thank you. Very, very helpful. Thank you.
Thank you. Your next question comes from Ruchit Puri from Millennium. Your line is now open.
Hi, thank you. Am I audible?
Yes. Yeah.
Okay, great. Thank you for taking the time, first of all. And thank you also for your comments on the economy as well as the business. Obviously, everything's super positive, touch wood. I guess, it's become largely an accepted fact now within markets that, Indian economy overall, and especially HDFC Bank has come out of COVID pretty handsomely, much better than what most people feared. And the asset quality cycle seems to be behind us, and with a firm sort of focus on growth now. My question to you, I guess, is what is the risk to the statement that I just said? What is the risk to this view? Are there any parts of the book that you're seeing signs of stress in that or any parts which are giving sort of warning signs to you, or is it or would you agree with the fact that the asset quality issues are almost completely behind us now? Obviously, assuming no second big COVID wave, and then you can sort of press on the gas and focus only on growth going forward.
Go ahead, Rahul.
No, go ahead.
No, I was just smiling. There is no point in the business cycle that you take your eyes off credit and press hard on the accelerator and go. That has never been a model, and that will never be a model. And level of skepticism always exists everywhere. And that is part of the framework. The framework is there is nothing that we do without testing as a bank. Geography, customer segment, product, any new foray that we get into is nothing done without test and looking at the results and gradually expanding. And everything is driven through analytics, rational, so that it makes business sense, economic sense to do things, right? So you just want to set that so that it is not about what the economy is showing or what the macro is showing, and then you press the button and you keep moving. No, that's not how it is operated, and that's not how we are operating even as we speak now. Then your other question in terms of are we all behind and everything, and are you? So I believe Jimmy gave quite a detailed kind of a discussion in the, I think it was the 16th, on the 16th, February 16th call that we participated in terms of credit segment by segment, in terms of where we are and what is it that we should. So coming off the corporate, Rahul will talk more about it, but coming first about corporate, then we'll go into SME and retail. Of the corporate, we did allude to saying that all the recent originations that we have done and the overall, the book remains at about 4.35 or so, which is our internal rating in a scale of 1 to 10, which is equivalent to about a AA type of rating, right? So, and it has been stable, 4.3, 4.4 around the trend, it has been stable. So any news that is coming in we believe is of a good, robust quality, and that is how we have been selective in what we bring in. And the overall book has also done well, and that's where we are on that front. On the SME front, again, one of those where we have continuously done various stress tests, ran some models. The guarantee scheme has come and also helped the SME segment across the country in various kind of places to reintegrate and restart and chug along quite fast from their business sense, right? And that helps us. At the end of the day, when the business is going, we want to do business with all of them, right? So that is another one of those areas that is moving along well, and we were good participants and helping the SMEs to start their process and grow very well. On the retail front, secured or unsecured, I think we put out in terms of where we stand, both from an origination score point of view, where there are a few tens of percentage points we are better from a credit scoring at origination. And in terms of when we check the bureaus in terms of the delinquencies on a relative sense versus the industry, we believe we are maintaining quite a distance from that sense, from an overall sense, where we are on that front. We felt quite comfortable. That was the Jimmy on the January 16th. He described in great deal of micro aspects that he talked about, and there's nothing that we have as an update further than what we have said on that front. But yes, I do want to set it right that it's not just about scaling up and running away with the growth, but it is about having that in a measured manner. Rahul, I leave it to you for further addition in terms of how on the ground you are meeting the customers and running this.
Sure. So, just, obviously you pointed out the risk to the forecast, which is, a reappearance of COVID. But seems like the vaccine is there, and seems like, we seem to have managed it quite well. Other than that, we are running expansionary fiscal policy. And to the extent that we are not able to scale up on capex and it goes into revenue expenditure, that could be inflationary, but the monitoring is pretty tight. I think if you look at this restructuring experience, not for us, it's not really meaningful, but even in the overall banking segment, it is not, alarming, or rather even I would say meaningful, and that's a very positive sign. Now I look at my wholesale SME portfolio, and I think it's in the last 3 years, if I look at it, while the book continues to grow, the GNPA percentage of that book continues to come down. And in fact, beyond the GNPA percentage, you can say, look, book is growing, so that percentage, even if you stay flat, comes down. Every year, the GNPA creation is coming down. And that is the trend that I see. So I feel pretty positive, because that, puts wins on your sails and gives you confidence that you're going about it, the right way. And continue to step by step, keep scaling up. So I will just, basically stop there. I think, as you go forward, at least we don't have to, worry about NPA. And I would, rather focus on beyond, many opportunities. Look at this confluence that we have reached today. You have the production-linked incentive scheme. You have domestic sourcing, that was announced in the Atmanirbhar package. You have correction of inverted, import duty structure, and many large, things that we as Indians consume. And then you have tax incentives as well as, corporate tax rates. If you combine all of this, that goes out and, basically pushes, for growth. And today, NPA, you will always be cautious, because that is what has, brought the bank to this position. But your focus is firmly on, the growth ahead. The packages that have been implemented, you see, the benefits in the industrial sector, you see it in the auto sector, you see benefit in pharma sectors or defense sectors. So it's pretty positive. So today, basically, there was 9 months ago where we were looking at portfolio reviews and reviews and reviews and reviews. We still do that. But we look at, basically penetration and expansion and penetration and expansion. The management focus seems to be turning at this point of time.
That's great. Thank you. Really appreciate that.
Thank you. Your next question comes from Kunal Mehta from MLP. Please kindly unmute your line and ask your question.
Good afternoon, gentlemen. Sorry about the important attempt earlier. My first question was to Srini. Srini, I wanted to build on your observations about the interest rate and then specifically talk about how the coming rate cycle sets you up relative to NBFCs in terms of cost of funds and other competitive dynamics. And the reason I want your insight in this, Srini, is this time we're going to see rates rising against the backdrop of A, a very steep fall over the last 18 months, but B, significant government intervention into liquidity lines that are still out there. So it's not a typical rate increase cycle. And therefore, I want to understand how to play out and what are the competitive implications for the banks versus the NBFCs.
Okay. First is from the views on the rate cycle itself, right? The point that I was trying to recap is that in the short period of time, we don't see that rate cycle picking up. That was one of the couple of things that I mentioned. Is one is the credit deposit ratio is pretty low, so we don't see the rates picking up from that sense in the short term. Not at least until August, September. We can see it until then. Beyond that, we have to see depending on what RBI does with the repo reverse repo rates, right? So that's one thing. The second thing is in terms of RBI itself looking at their strategy is to control the yields. The posturing of RBI is not about let the yields fly out. It has been elevated in the recent times, but still it is the open market operations or twists and all of that, while liquidity neutral, they don't want to put more liquidity in the system, but it is meant to bring down the long end rate, and that means buying the long end and selling the short end. The short end rates are below the reverse repo rates, right? At this time, what we see the curve at the very short end, the overnight rates with the TRIPS are trading below the reverse repo rates, right? At this time. And that is what RBI is trying to normalize. Why is that happening? That the rates, the TRIPS rates are going below the reverse repo rates. How do you take it above? Maybe 3.5 or we don't know where it will settle. But how will it go from 3.1 all the way to 3.4, 3.5? That is at the short end. And then at the long end, the indication is that trying to manage it at least a 10-year give and take at 6%. It's hovering between 5.9 to 6.1 up and down all the time. But how do you maintain that? That is what RBI is trying to do. So the point I'm trying to make is that at this moment, while it is moving in a narrow band of 10 basis points, 20 basis points up and down as these actions come through, we haven't seen a great runaway factor in terms of the rates. And one other influencer of the rate is also the inflation. And how is the inflation, right? Is that going out of hand in terms of where it calls for rates to be adjusted to manage the inflation? That's not what we are seeing either, right? While we have seen improvement in inflation 1 month to another. When we look at the prior month to the latest one, we do see some good pickup or good kind of reduction in inflation from that sense. And we do expect in the first half of 22, which is April to September time period, the average inflation would be around 4.8 to 5.3. That's our economist in our view, right? That's where we think it's going to be. And currently at anywhere from 4.4 to 4.6, that's the kind of an average in this quarter. That's where we see. And so we are seeing that it will be stable around that level. So we don't see the rates jumping out, at least not in the near term. So that's one thing. The second thing is in terms of what does it do in relation to the NBFC as a segment, right? Yes, NBFC segment for a large part is either borrowing from banks or borrowing from the market in the capital markets, and their NBFCs rates have fallen down. They have seen the betterment in their cost of funds over this time period, and what it has done to NBFC is that to some extent they were able to price to better customers and lower their yield, and to some extent it has fallen through to their bottom line, or at least to the pre-provision, to offset some of their credit cost increases. Right? So that's what has happened in terms of the NBFC. Maybe Rahul, you can talk about how, as you deal with NBFCs in terms of the credit demand from their side, because you are lending to them.
Yeah, so look, NBFCs, in many cases, we go out and do lending onward lending for priority sector lending targets, right? And if you look at it, the NBFC, or you could go out and do a securitization. So, when NBFCs were strapped on liquidity, there was a lot of full purchases, PTC, securitization, those type of transactions. I could say, June quarter was something like that. September quarter was something like that. But as you move forward today, in this quarter where they are drawing, that is basically for onward lending. And so that is, new demand that is coming in, and situation is very different. I mean, no different from what would be maybe the beginning of, 1 year ago, because the second half of, the March quarter last year, again, everybody was consumed with pandemic. But that's sort of where we are. And I talk about, the pool of NBFCs that we lend to, which is, the top tier and the better quality one. So you have the public sector and the MNC. So NBFCs, you take them out. You take, corporate backed NBFCs, which is sort of, where we have exposure. Independent NBFCs less so. On the corporate backed NBFCs, we do see actually fresh lending going on. Sorry.
Thank you.
Is that now the question, or are there parts of the question that I haven't answered?
Can I, the risk of being blatant, push on one particular subset? Look, there's so much liquidity in the system, A, and B, one of the things we're hearing a lot from NBFCs and the scheduled banks are that they both are trying to target a very similar asset pool increasingly, right? Because once you take infrastructure, power plants, stressed SMEs out of the picture, and you largely think about securitized retail and cash flow-based SME lending, they're going up the same pool. And while everybody has a different niche they address, now the part we've been trying to struggle with is that has there been any fundamental change in how rates are going to play into this to allow either one of them to have an edge competitively?
At least I will speak first and then Rahul will join. I want to say, at least from our bank point of view, the segments where we operate various businesses from retail to SME, in this examples that are what you have alluded to, our customer segment and profile is different from where the NBFCs play. They are at a different kind of a customer segment operation level. Where we lend and where we try to leverage is on the CSL, as Rahul alluded to, where certain priority sector or needy sector, where we don't, as a bank, don't have the reach. We go through some of these top tier NBFCs so that they have the reach to get that for us. That's the only thing that we try to get partner and get it out. Otherwise, from a core customer relationship point of view, our bank's customer relationship is different in the pyramid of a customer segment. If you see, we are at a different kind of a customer segment compared to where the NBFCs are operating. And that is one of the reasons why the NBFCs are able to price them differently too, for the risk that they take at a different segment level.
Got it. That's helpful. Thank you again for your time.
Thank you.
Thank you. Your next question comes from Artavisha Banerjee from ICIPRU. Please go ahead.
Hello, sir. Please go ahead.
I figured out. Can you hear me?
Yeah.
Hello? Yeah. So the first question is for Rahul, sir. So this is actually a combination of a few points we actually discussed already. See, on the kind of corporate lending that HDFC Bank is known for, we know that the rates over the last 2-3 quarters have been very, very soft. There has been some inching up over the last couple of weeks, but this market is largely dominated by the top 2 or 3 banks in the system right now. So the question is, for these kind of rates and these kind of the segment of corporate lending, the large corporate and the PSU segment that we do, given where our cost of funds on a blended basis are, is this sustainable? And the other argument we get from some of the other banks for doing this is because it's a whole suite of products. It's a relationship where you get liabilities and you can cross-sell other opportunities. But my point is, for HDFC Bank per se, the lending on the balance sheet need not be the only criteria to get into a relationship, right? For the top corporates or PSUs, you would always, reasonably be entrenched over there in terms of presence. For some smaller bank, it definitely does make sense. But pursuing a 4.5% paper, as someone already talked about in Ultratech in corporate, how sustainable is that given where the cost of deposits are?
Sure. Okay. So look, when we talk about where we do lending, we are not a bank that just goes and does lending, right? Obviously, lending is important. We have a branding because of which we have low-cost deposits. The bank, creates from across the system. We have a fortress balance sheet. We have capital and not NPA, so we're not hobbled by that. So we will be able to lend in size, and we will be able to lend at a competitive pricing. When we talk about size, many of the banks basically fall off at times on the topmost end, right? The second is effectively just the speed at which you turn around, and the bank is known for that, whether it is retail or wholesale, and that makes a big difference. The third is just the digital plus, retail cross-selling that we offer to corporates, which is quite a strong, winning factor. And the last is service. On March 31st last year, when we were under lockdown, there were so many corporates, top corporates, who came back and thanked us because we were processing, their transactions at midnight in the middle of lockdown and in the middle of COVID when we didn't know, much about that. But if you step back and see, what is happening in the economy today, you look at, 2-3 years ago, we decided that the customers that we know, when, the future is uncertain, we are going to go a bit deeper. Rather than go out and spread your, wings, all over the place, because it's easier, to give money to a larger corporate and not lose money rather than, on board on the corporate side, several customers with small lending where you are definitely going to have NPA. So we said, okay, let us look at, systematically and increase. Now, what has happened? Where I was in working capital, consortium with 5%, I was at 10%, 15%, 20% now. And now you have the current account circular, right? Above 10% is where you have the ability to go out and open a current account and do, the flows. Sure. We are the main transaction bank for most of our corporates. So suddenly, many of the larger corporates are saying that, look, I want to deal with, these banks who are the 10% banks. And the moment you go out and talk about it, that is just a handful. And when you talk about lending plus, the cross-sell services that corporates acquire, whether it's, FX or payments or collections, etc., that does not go to everybody. That goes only to reliability and the technology platform. So I am, going to continue to benefit, as a result of certain changes in the regulatory setup as we go forward. And that's sort of how I would answer your question, Bob.
So the regulatory result is one of the practical concerns. Sure, that makes sense. But just one bit of technical question, if I may. This is for Srini, sir. So if I look at your Basel disclosure, sir, when you classify the risk-weighted assets between less than 100, 100 and more than 100, the more than 100 number seems to be very large. It's about 1.8 lakh crores in the last number, if I'm not wrong. If you remove the credit card piece, which attracts 125, what are the other segments in the consolidated lending book or exposure rather, which attracts a more than 100% risk weight to warrant such a high number?
I wouldn't have that number readily in front of me, but there are categories. These are all standardized risk weights, right? This is not something that like an advanced approach or an analytical approach through the Basel. That is not what it is. These are standardized according to the RBI risk weights that get applied. Which category offhand, I don't have those categories, but you can engage with Ajit and he can give you the schedule. Yeah, he'll give you the schedule of RBI rates which are more than 100 according to what categories. Yeah.
Sure. Thank you.
Thank you.
Yeah. So just in interest of time, we'll take two more questions. But before that, I need to ask a question that I've been receiving on emails. Rahul, that is to do with the ECGLS. Of course, HDFC Bank is one of the large disbursers under that scheme. So clearly, of course, there are business reasons. Of course, the way the scheme was framed was very restrictive in terms of who the bankers give this out to in terms of the liquidity support. How do you see this scheme? Let's say a year or two down the line when the moratorium goes out and the principal when the payments start to happen. Do you see this continue to be a great opportunity, or you think there could be some potential minefields in this whole scheme?
Yeah, Rahul, so I'll tell you, yesterday there were two newspaper articles. One was in Times of India, which says that HDFC Bank, does higher ECLGS disbursements, than SBI, and it was a positive article. There was another article in the business line which talked about, bankers worrying about ECLGS because of NPA, right? Now, step back. Let me split, 1.0 and 2.0 because there are two versions of the scheme, right? So when we started, my team said that, look, if we do this aggressively, our earnings will go down. And their fear is that, look, the overdraft that clients draw from the cash credit account, right, that will get replaced with the ECLGS. Overdraft is priced higher. ECLGS is, priced lower. And so we are going to, have a loss of earnings. So I had two counters to them that, look, overdraft goes up and down. We don't know, how the behavior is. Term loan is, basically gives you a certain amount of stability. Secondly, if you believe that your MSME segment, given our NPA and collateralization, self-funding, etc., that we look at, if you believe you have a good book, as the customer goes in the next 2 years, you will, basically increase credit capacity or credit extension by, 10, 15, 20%, right? Now, by giving this, sure enough, most of the customers availed the ECLGS 1.0 and they liquidated their overdraft book, no problem. But come 31st December, after a year, basically they started reusing, the overdraft book in terms of, the orders that you saw. So what we've achieved is that in the next 2 years, I would have, 20% extra, asset because overdraft, will be utilized. So I will be earning on, 120, but my risk capital is maintained only on 100 because the 20 is, basically government guaranteed. So, why would you not go down and do that if you have basically a very good client base, which is what we see. But now, if you were a bank which was, going to do this to manage NPAs, then, I worry because you are, trying to arbitrage against the sovereign and playing with fire. So whoever has done that, they will basically have an issue when these things, go bad. And systematically, large proportion of the portfolio goes bad, it's a little bit, will come into some sort of inquiry. Now, the 2.0 is something where we are much slower. And that has got to do, with basically the design, of the scheme. Because in 2.0, there are normally multiple banks. And the scheme requires you to perfect a second charge. Now, when I see this, if I give, on my proportion, 20% extra money, I have to perfect, basically a paripasu on that, and then I have to create a second charge in favor of the government. Now, if I don't get the NOC, which is, what the issue is from other banks, I am not able to perfect pari passu and I can't create second charge. So I sometimes wonder that banks are going out and doing it. We don't get a lot of inquiries for NOC. And how are they going out and doing it? Because a key to this NCGTC guarantee scheme is that you will have to perfect that second charge, and that date is until June 30th. Now, if I do the last disbursement on March 31st today, I don't think I'll be able to perfect the security even if I have the NOC by June 30th, because today there is a big pipeline in the SROs in the states, and it takes about 45 days or so to go out and get signed. So it sort of slows down. So the government, they may go out and extend that particular timeline, but the security perfection is very, very key. So coming back, I give a sound business logic that you are able to extend credit without or expand basically the lending book without expanding the risk capital. So that is basically fantastic. And if you think your customers are good, you're going to go out and do that. If you're doing NPA management, you're going to come to grief anyway, and that is not what we see, because I told you my GNPAs have been coming down every year in this book for the last 3 years consistently. And the second is on 2.0, unless certain contours change, which we have given suggestions, at least the security creation timeline and this NOC process, I don't see ourselves, go out and scale up, basically, or be able to disburse quite a bit of money. But we are good, we feel good as to, what we've done and where we are. In 2.0, I'll tell you, because it is, to be extended to small and also to mid-size, corporates. But the fact is that you can use only one benchmark lending rate. So we have an external benchmark, lending rate against which we, do that. Now the rates at which, basically mid and large corporates borrow and SMEs borrow, there is a wide variance. And so we've said, okay, since I don't have the ability, I would focus on the smaller wholesale SME and continue to, do that and build that granular book.
Makes sense. With your permission, can we take two more last questions? Would you and Srini be okay?
I have something coming up with I'll stay for next 3 minutes or so, Rahul. I have
okay, so we'll just take one more question then. Yeah, we'll just take one more question. Jason, one more question and then we close the call.
Certainly. Your last question comes from Simon Ho from 9 Please go ahead. Simon, your line is open. Please kindly unmute your side and ask your question. Thank you.
I think perhaps he's dropped off or we are not able to hear him. So then we'll close the call. Srini and Rahul, thank you so much for taking the time out. It was a pretty engaging conversation and something which you both talked about, how the economy could look like, how the banking system is positioned. Hopefully it plays out, almost like that, and hopefully India benefits from this cycle. With that, on behalf of Goldman, thank you, Rahul, Srini, and Ajit for agreeing to do this call. And then I'll be in touch separately. Thank you so much once again.
Thank you. Thanks to the participants too. Thank you. Bye-bye.
Ladies and gentlemen, thank you for participating. You may now disconnect your lines.